or anything else, right?
All right. We are now live. Hello, and welcome to those of you joining us just a couple of minutes early. We will be getting started here on time at 11:50 a.m. That's Eastern time, coming up in just, again, a couple of minutes now. I do have Michael here with me in the Zoom room. Thank you all so much for your patience, and I hope you're enjoying the show so far. Hello, everyone, and welcome. Our speaker for this session is Michael Kramer, founder of Mott Capital Management, and a long only investor who focuses on macro themes using a wide array of tools to understand what drives the market on a daily basis. Now, that's just a little bit about Michael, but he is here today to share some of his expertise with us, and he's looking forward to answering your questions. So, to our live audience, don't be shy. Throughout this session, please feel free to share any questions or comments you may have in the live chat box. It's on the right-hand side of the video player. And time permitting, at the end, we will get to some live Q&A. And with that all said, Michael, I'll hand the mic on over to you. I'll be here if you need me, but the floor is all yours.
Thanks for having me back. I love doing these with you. And please, if you have any questions, please submit them. I'm more than happy to take some questions on the slideshow that I'm going to present to you, or even, things that are outside of the slideshow. I'm always more than happy to pull up my trading view or my workstation and go over other parts of the markets that you may have questions to, as long as I'm able to answer them in terms of my level of intelligence. Um, anyway, this is just a quick disclaimer. I'm sure everyone had a chance to already review it. Just remember, I am a registered investment advisor, and I'm not making any personal recommendations. This is all, kind of just broader macro topic stuff that we're just taking a look at to see if we can understand what it means and what it means for where the market's likely to go. And so I had done one of these presentations over the summer with you, and I think at the time we were talking a lot about reserve balances and liquidity in the marketplace, and how liquidity was going to be drying up in the second half of the year. And I just wanted to take a look back at what was then and versus is now. And so this first chart shows us reserve balances in dark blue, and you're going to have to just excuse me because the colors are going to switch a little bit, but I'll make sure to keep you up on it. The dark blue line is basically reserve balances. So for you, those of you that don't know, reserve balances are basically the amount of excess liquidity that sits on the Fed's balance sheet in terms of Fed's assets minus its liabilities. And so this is basically what institutions, commercial banking institutions, have held at the Fed. And when we were, over the summer months, it was somewhere around 3.3 to 3.5 trillion dollars. And what's interesting is that changes in reserve balances over time tend to have a relationship and a correlation with the amount of margin and leverage that's available in the equity market. So this chart shows you in dark blue reserve balances, and in light blue FINRA margin balances, and we had just broken $1 trillion in margin balances for the first time ever back over the summer. And this is where we are now. So right now, what we've seen, you could see I switched the colors up. Dark blue is FINRA, which has moved up to about 1.2 trillion. And we've seen reserve balances fall at the Fed fall below $3 trillion. Currently, they're right now around 2.8 to 2.9 trillion. So we've seen about $550 billion removed from the Fed's balance sheet over the last few months as the Treasury General account has started to rebuild. And now it's basically rebuilt, and we'll get to that slide in a minute. But what this means is a lot of that excess liquidity that had been in the market, for simplistic terms, has been removed and is no longer available. And that's caused, I think, a lot of the volatility that you're seeing in the marketplace right now. And at the time I was, speculating this was the type of action we would probably see later in the year. And this chart shows you at the time, light blue S&P 500 versus FINRA margin balances as well. Again, we were up around $1 trillion. The equity market was rising. Everything was great. Lots of liquidity in the system is what this is chart basically telling you. Now we've seen margin balances continue to rise, and stock prices for the most part have continued to rise too, although more recently we're starting to see some liquidity concerns and some of that coming down in the equity market. And this chart shows you basically where the equity market was back over the summer versus where reserve balances were. Light blue reserve balances, dark blue equity market, S&P 500, and this is where we are now. So there's obviously been a very big divergence between where Fed liquidity is, where the S&P 500 is, and where margin balances are. And I want to draw your attention very quickly. We're going to go back one slide. We're going to go back 2 slides, and we're going to take a look at margin balances in 2017 and 18. Notice margin balances actually started to decline before the, margin balances started to decline right around the same time that you saw the equity market decline. And when we go back to this slide here, what you notice is that reserve balances started to fall well before margin balances started to decline. And now if we fast forward back to today, you're seeing a very similar sort of setup where margin balances are still rising, reserve balances are clearly falling, and the S&P 500 is still rising. And this is really more of a result of the TGA going up and the reverse repo facility being drained. So the reverse repo facility is a place where banking institutions or any sort of institution has access to the Fed's temporary open market desk, can basically go and basically take cash, give it to the Fed. In return, the Fed gives the bank collateral and pays the banks a rate of interest. And so basically what's happened over the summer months is the rest of the reverse repo facility has been completely drained. And basically what we've seen now is the TGA go from around 350 billion to 920 billion. Reserve balances have fallen, like I just noted, to around 2.9 trillion. So all this liquidity basically has gone to funding, the government in a way, because the TGA is essentially the government's checking account, right? So they make their payments for whatever it is, Social Security, healthcare, the military come out of this general Treasury checking account, and they keep it flush with cash by issuing debt, right? Treasury bills, coupons, and things of that nature. So every time we have a treasury auction, that's because a government needs to raise money to fund the TGA so they can write checks out and pay their bills, just like we do with work. And essentially the Treasury gives us every quarter a target for where they want the TGA to be at the end of the next quarter. And right now, for the end of the December quarter, they're targeting $850 billion. And at the end of the March quarter, they're targeting $850 billion too, which tells us an important fact, which is that the TGA right now is a little bit over where the Treasury wants it to be. And we could see the TGA fall by about $50 or $100 billion to get back towards target, which would add reserves back into the system by about $50 or $100 billion. But at the end of the day, the TGA should really go into some sort of steady state, similar to what we saw in October of 2024 through, October of 2023 until about March of 2025. And that was the only reason why you saw the TGA get drained. I know that a lot of people on Twitter, for example, or X, or whatever it's called, have these conspiracy theories about how they drained the TGA to kind of boost equity prices and all this other stuff. As far as I know, we're not going to have another debt ceiling issue. So we shouldn't see the TGA drain for any reason at this point because the government has the ability to access the markets. And we should really see it in some sort of steady state period. We shouldn't be seeing any sort of big drawdowns in the TGA because, again, the debt market is going to be fairly the debt market will be accessed, and they're telling us they want it to be at $850 billion. Generally, the rule of thumb is they like to leave about a week's worth of excess cash in the market, in the TGA, to be able to fund the government in case there's some sort of emergency and they can't access the debt markets. And there have been warning signs all along that there was going to be this liquidity crunch coming. Back over the summer, I was talking about the standing repo facility. Probably not many people had heard about it, but this is a place where the Fed has the ability to give institutions cash in exchange for collateral, and the banks pay a rate of interest. And so basically up until June, we basically never really saw anyone access this because there was plenty of cash and there was no need to. Well, that's all changed. All of a sudden, June's $11 billion, which was huge at the time, has obviously been dwarfed by the $50 billion that was used on October 31st. And you can see that the standing repo facility since the beginning of October has been used on a much more consistent basis. And what that tells us is that right now liquidity is tight, that market participants are having to go to the Fed to get liquidity, to get cash for whatever it is their overnight funding operations are. And to get that cash, they're giving collateral and paying an interest rate of 4%, an annualized interest rate of 4%. And they're also now, I forgot the key point here, is that they're also allowing you to access this facility not once a day anymore, but twice a day. So they have a window open at 8:15 and with the announcement at 8:30, and another window open at 1:45 where they come out with the announcement as well, starting at 1:30. Again, for institutional investors only. Other warning signs were again, published every day at 8 o'clock in the morning. SOFR, secured overnight financing rate. This is basically the average rate that institutions are paying in order to, do their overnight financing, the general collateral rate in the repo markets. And again, I don't want to get into the technicalities of it, but right now you can see this rate generally changes with the rate that the Fed has on the effective funds rate. Generally speaking, this rate trades below the effective funds rate. So if the Fed has a target rate of 4.25 to 4.5%, the SOFR rate should be somewhere between there. And you can see for the most part between the beginning of December and the middle of August, the SOFR rate was fairly stable, and it traded around 4.33%, which happened to be the effective funds rate. And this, of course, these big drops weren't due to something going on other than the fact that the Fed was cutting rates in the fall of 2024. Now, what we've seen is not only that SOFR on this chart, we're showing the green band, which is the effective lower bound, which is 4.25%. This is the effective upper bound, which is 4.5%. Again, you can see how we were nice and tight in that range. But what's happened since October is not only have we moved up in the range, but we've moved above the range on SOFR, meaning that we are now seeing rates on SOFR exceed the higher 4% overnight rate that the Fed may be targeting right in here. And that's when institutions will then go to the standing repo facility to access cash because market collateral is more expensive than the Fed's upper bound. And that tells us that liquidity isn't just tight, but it's very tight, and that it's very expensive to get financing to do your overnight operations. And this is really important. It tells us a lot about it, but not only has the rate increased, the volatility in the rate has increased. And that's also extremely important as well. The more volatile it becomes, it tells us just how difficult it is to obtain it. And one way to measure it is secured overnight financing rate minus interest on reserve balances, which is, again, another rate that the Fed pays institutions to keep their reserves on balance at the Fed. And you can see that spread has, again, very low volatility. Volatility started picking up into the end of the year, which is not unusual. Volatility started to get a little bit, more towards, in the summer. I'm sorry, in the spring. And then you can see in the summer months, it just really ramped up. And now what were kind of extreme levels that we would see every once in a while around a quarter end or a month end or a year end are now basically happening on a daily basis. Um, and so the idea here is that there's just not enough liquidity in the marketplace to kind of keep everything running. Everything is running. It's running not, but it's just not running smoothly. We're not like at a point where you're gonna, all the engines are gonna seize, but you're at a point where things are getting tighter. The ample liquidity days of yesterday are gone. And that in my belief, which if you go back to the earlier charts, led into excess margin. Well, I'm sorry, led into, the ability to lend, lever up, help boost equity prices together. I showed you in the beginning how all those things kind of went hand in hand. And one reason also is that right now dealers are holding lots of treasuries on their books. And that's another factor as well, because if generally when we think about about treasury issuance, someone needs to buy that debt, right? And so when the books of the banks hold lots of treasuries, that basically tells us that they don't really have much balance sheet capacity to be a big buyer of a lot of these treasuries. That means that the money needs to come from someplace else. And where is it coming from? It looks like from an observation standpoint, it could be coming from risk assets. If you certainly looked at the price of Bitcoin, which I think was down another 3 or 4% today, it certainly seems like it's coming from somewhere, and it looks like it's coming from some of these risk assets. And this is important. And you can see the primary dealer balance sheets really haven't changed very much since August, which tells me that dealers aren't absorbing the excess issuance by the Treasury. It's coming from other risk assets. And I think that this is really important because it means that the liquidity in the market that we saw in June, July, August that helped to lift the equity market back, or even propelled much of this market over the last 4 or 5 years, that's gone. In my view, that liquidity is gone. The repo facility was a good measure of that liquidity. It went from $2.5 trillion basically to zero. As of yesterday, there was less than $1 billion. And so if the money isn't being absorbed by dealers, it's coming from risk assets. And I think this sets up the first leg of what I call the perfect storm. And the next part of the perfect storm is basically the credit market has now turned against AI spending. And what we're looking at here is a chart of Oracle's 5-year CDS, which is the 5-year CDS credit default swap. And this is basically insurance against Oracle going into default. Now, 100 is still a very low number overall. It suggests something like an 8% default rate over the next 5 years. But the point is this was at 60 back in September before the company reported that number with OpenAI, and the stock went up 35 or 36% in one day, because the market's looking at the amount of Oracle's capex, to say the way it's rising, its free cash flow, which used to be positive and now is negative, which is expected to continue to be negative on a trailing 12-month basis. And the market is now changing its view on AI spending. You're seeing the same thing happening. This is one of the reasons why, and I think you're seeing the same thing happening in stocks like Meta, which has also been getting pummeled lately. So I think the market is really rethinking its aspect on spending, free cash flow, and the valuations it's assigning to these companies, because all of a sudden the narrative of the last 5 years, these stocks being sort of a safe place, as a port in a harbor in the midst of a storm, the Magnificent Seven, suddenly look very different. You used to be able to say, well, Meta's a free cash flow cow and it has a solid balance sheet. But now you really can't say that anymore. If you've taken a look at Meta's balance sheet, it's changed dramatically over the last year in terms of just how much cash they hold. And so you're seeing this change in the way the market's viewing some Oracle specifically. And what's important is Oracle is within the CDX investment grade index. And what's interesting to me is that basically what this is telling me, oops, sorry. I don't know. Basically what this is telling me is that you're seeing, in my mind, investment grade spread should also really start rising. If you're going to see Oracle, which is part of the investment grade index, have its CDS go up, you should also see the spread on the overall investment grade index also go up. And the next chart I'm going to show is basically the bond market is now turning against Japan. Japan has this big, big new prime minister came in. She wants to, she sort of was under took the Abe sort of approach to economics, wants to do this big stimulus plan, wants to spend something like 25 trillion yen, which is a big amount. Bond market clearly does not like that. We're looking at right now a 10-year JGB, which is now trading up to 177. And, what I'm kind of getting to here is that it looks like it's probably still going to go higher. And so remember, Japan, for many, many years, the carry trade, interest rates always went down. Interest rates were near zero or below zero. This was the funding currency of the world. Now, all of a sudden, it's a lot more expensive if if from that standpoint, that ample liquidity that was once there may no longer be there. And if we're going to go into some sort of permanent state where rates in Japan are just going to be much more expensive because they have a Bank of Japan that's not really raising interest rates as aggressively as they should. They clearly have an inflation rate that's well over 2%. It's more around 3%. And they've obviously had a long bout of deflation, and you can understand their kind of worry. But the bond market right now is giving us a pretty clear message that right now it's, kind of turning its back against Japan. And you can really see the effects, the nervousness that is now taking place in the market given these dynamics of the spending plan. And I think the final leg of the perfect storm is that we've been in record low levels of volatility when it comes to 3-month realized vol. This was something I was working on a lot over the summer, and this was one of the key parts that were also going along with the liquidity picture. What we were seeing in the equity market during the summer months when we still had lots of liquidity were 3-month realized volatility levels that had only been seen in the last five to 6 years. Well, actually back to 2017, in this January of 2020, in October of 2018, and December of 17 into January of 18. I can tell you what all those periods followed. We had Volmageddon, which was in January of 2018. We had the Christmas Eve massacre, which was December of 2018. We had that big 20% decline in the fourth quarter of 2018. Then, of course, we all remember COVID. And here we are today. Notice there's one characteristic that's kind of developed over the last several weeks that I've been really noticing. Notice that 3-month realized vol has started to go up. Notice that 3-month realized vol started to go up. Notice that 3-month realized vol started to go up before the equity market sold off. And so it's quite possible to me you have all these different forces now coming together, which really kind of paint the picture for me, which is risk off, right? I want to be defensive. I want to be really careful with what I'm doing in the marketplace. I mean, it's getting a little bit too late, but you had a really nice window where if you could put hedges on with cheap implied volatility levels, you probably could have wanted to do something like that, right? Now it's getting a little more expensive to do that. But, when you have the main theme of the AI story, CapEx spending, right, being challenged by the credit market of all places, that makes me worried. When I see liquidity and overnight funding rates tightening, that makes me worried. When I see what's happening in Japan with interest rates, that makes me worried. These are all things that make me really worried. And make me think that this market downturn we're seeing isn't something that's just going to be a buy the dip opportunity. I've been writing about and talking about the equivalent of the 2018 type of event, mostly because it stands out because it was in the fourth quarter, but very similar in characteristics to the liquidity standpoint, and also from the volatility standpoint. Then there's been this chart I've been following since 2022, call it. It's an analog chart. I know lots of people are kind of skittish on analogs. They don't really believe in them. And I like analogs. I like to use them until they don't work. Eventually they don't work. This analog, to my own detriment, has continued to work despite all the odds. What I'm showing you here are basically two offsets. The purple line has a little bit of a longer offset where it started right here. This was, if anyone remembers, this was October of 2020. It basically correlated really nicely 1996 with the 2022 sell-off with the low here and the low here. And if you had followed this analog, you would have been perfect because the market did nothing but go straight up and nearly follow the analog perfectly. And I thought for sure at some point this just can't work. So I didn't, I kind of checked in on it every few months, kind of see if it was still there, and it was still there. Then, like, something changed in it because what happened was it shifted. It shifted from being the purple line to what looks like now the orange line. And what was interesting was that this analog was basically not calling for this sell-off that we started to get in January and March. And I, at that point, kind of thought the analog was finished. But then again, the analog was also saying we were going to get a sharp sell-off and a big rally back. And I was like, no, that's just it. The analog is dead. And then sort of to my disbelief, we got the same bounce. But what I also found was that it shifted forward to this orange line where we got this sell off here that matched up with this sell off here. You got this low here that matched up closely with this low. And now, lo and behold, I wrote in my free blog the other 2 weeks ago, a week ago, I said, well, the 1966 analog says this is it. We're going lower. And, uh, and sure enough, that's what's happened since. And just for references, that's what the analog shows. The thing that I've noticed, though, is that the analog down 22% doesn't line up with the market from a percentage standpoint. In fact, if I remember correctly, I think this decline was only like 2 or 3%. This was at, call it 93, 94, and it went down to like 88. So if I just do the math really quickly, uh, 94 minus, sorry, I can't do this in my head, divided by 94 is about 6%. So far we're down about 5 or 6%. But what you can see though is that this analog is suggesting there's still further to go. So I don't know if there's like, from a percentage basis, I don't really worry as much about it. I just care about it from a timing basis and from a sort of footstep basis. And so when you put all this together, it really kind of again creates what I call a perfect storm. And I think at this point, if anyone has any questions, I'd be more than happy to take them.
Thank you, Michael. Now, I know that our audience is a little bit delayed behind us, so I'll give them a couple minutes here to catch up and ask any questions. Don't be shy. Again, if there's anything you want to ask Michael, now is the time. And while we wait for them, Michael, do you tend to get any frequently asked questions when you do other sessions? Or just is there anything that you think our audience might benefit from hearing about while we still have you?
Um, I think generally speaking, the liquidity stuff has a lot of people's interest all the time because I think there's a lot of misunderstandings about liquidity, and how it works. And I try to focus purely on what's happening from the Fed balance sheet standpoint. I know a lot of people will focus on things like M2 and global M2, and I'm not really a big believer in M2. I get that, when it's going up, it's an indication that, the monetary base is expanding, but that doesn't necessarily, in my mean that stocks are going up. I mean, the things that have the tightest correlations to me that I've seen, and I've been studying this actually since about 2015. And the things that I've always noticed is that the correlations and the relationships between the amount of availability of margin and reserves have tended to track each other very closely over time. And in my book, if you're going to see a giant drop in reserves, it's just a matter of when will margin levels really begin to fall. And I know that once margin levels begin to fall, the equity market's not going to be too far behind it because that's really the only way I can figure out there to be a transmission mechanism. And I try to keep it really simple.
Thanks, Michael. We do have some questions here now, actually. That was just enough time. Eddie had asked, would you still invest in hyperscalers like PLTR and NVIDIA?
So I've never invested in PLTR Palantir, and I've never invested in NVIDIA. And to be truthful with my own portfolio and the money I manage, so I was an early believer in Microsoft Alphabet. I mean, I guess, in 2000, looking back on it now, it was obvious, but I think back in 2017, 18, and 19, which was when I was, moving into these alphabets and Microsoft and Apple, those were the three core holdings that I originally had. And then I ultimately bought Amazon in 2022. I was really a believer of them in the standpoint of, they had great business models, free cash flow. They were in the parts of the market that I believe they were very ingrained in our daily lives. I mean, I'm a big Apple user, big Microsoft user. My kids consume YouTube like it's going out of style. They can't get enough of YouTube, right? And these were all the things that drove me to it. But now I realize, after holding these things for almost a decade now, the business models are changing and they're becoming much more capital intensive. And that worries me because what if they're making the wrong bet? What if they're overpaying for all this stuff? And what if we find out that, you could build an AI model, DeepSeek, for example, for a tenth of the price of what is being spent now? What happens to all that investment that they made? What happens to their CapEx? What happens when it gets depreciated? I can't sleep at night because of that. Literally, like I worry about this stuff all the time because I lived through the dot-com bust and I saw similar things happen. And so I've been trimming my positions in them. I don't do it all at one time. Like I trimmed Microsoft back in the spring, and then I trimmed Apple back in the spring, and I trimmed Alphabet just a couple weeks ago. And, so I just try to pick my spots. There's no rush in my view, but I've cut my positions in them pretty dramatically. And I've been kind of looking for other parts of the market to invest in that are much more undervalued.
Thanks, Michael. Squeeze in another one here from Joel. What is your SPX target based on your analog?
Um, I haven't figured out the target on the analog, but I mean, if you kind of take more of a fundamental approach to where the market should be, I try to use like an 18 multiple on like 100 and what was it, like $290 per share. And I tend to come up with a number that's in between the 5,100 range. If I can just, if you just give me a minute, I'll figure it out exactly. Um Yeah, it's like around 51. It's in that 5,100 to 5,300 range, assuming we return to something more normal. I mean, again, the analog showed a 22% decline. So if it's one for one, and we see a 22% decline in the S&P, and we're, currently around what, 6,650 or 6,600 or something. You're talking about, 5,100 or so on the S&P. So I guess from a fundamental standpoint, that would line up. I don't think that's out of the realm of possibilities, by the way.
Fantastic. Thank you, Michael. I know we are just squeezing out of time here. I'll try and just throw one more question your way because we did get a few that came in. Theodore had asked, do you expect major equity market correction given that 2026 is the second year of a presidential term? What magnitude of correction for SPX in what time frame?
So I think it depends on what happens between now and when the Fed decides they want to start expanding the balance sheet again. Um, the next month is a critical window in my mind, because that's the time period where the Fed is basically doing nothing right now. We know they're still doing QT until December 1st. The Fed meeting isn't until like the middle of the month. So you have like this window where, for the next month, you're going to be in these tight liquidity conditions, that are going to potentially weigh on the market, and how we come out of the Fed meeting and what they say about what their plans are with the balance sheet, I think are going to drive that. I think if they act quickly and they say they're going to start expanding the balance sheet and you start seeing that happening sooner, you could obviously curtail a lot of a decline, but I don't really have a time frame in it. It's more about watching the market and taking it day by day in terms of figuring that out. But I'm in the mindset that the movement we're likely to see is similar to that of the fall of 2018. I mean, even when you look at this chart here, this analog, it looks like it starts somewhere in the spring of 1966, and we bottomed by, the summer of 1966. So that was also a fairly quick sell-off and a snapback, which took us ultimately to new highs. And so again, if you consider that the sell-off started in, the beginning of November, this could be over by March.
Well, Michael, thank you so much for joining us today. Great session, fantastic little Q&A there at the end. It's been a pleasure having you on.
Thank you. I enjoy doing these. I hope, it's not, I know it's not happy stuff for people, but this is what I'm seeing, and I'm just trying to present, a good portrayal of what it is.
Absolutely. Well, even if it's not happy news that you have to share, we're always happy to have you on our events. So we look forward to seeing you again next time. And to those of you watching us live, be sure to stay tuned as we do have a lot more in store for you today in this Money Show Virtual Expo. I do hope you all have a wonderful rest of your day. Take care.